Claus Carøe, lead portfolio manager at Sparinvest. Why should investors look at Danish fixed income bonds?
We are in a period of high anxiety about unsustainable debt ratios, and I believe that Denmark is one of the prime countries that should be on investors' radar screens because of the sound Danish fundamentals.
But Danish bonds, why should people outside Denmark look at Danish bonds? If we compare to German or French bonds, are Danish bonds better or more interesting?
Danish bonds are attractive for Danish investors, and I believe that should be for foreign investors as well. Because what we have in Denmark is a very solid domestic investor base. And that means that Danish bonds are not to the same degree as, for instance, German government bonds, influenced by fast money speculations or risk-averse investors going out of equities and into bonds and rushing out by the first opportunity they get for reversing their trades. There is a solid investor base, and means that it is also a very, very stable investment environment for foreign investors.
But Denmark is not part of the Eurozone. How does that affect investment in Danish bonds?
It means that there is a currency risk. There is a target zone that the Danish central bank is monitoring, but in practice, the FX rate between euro and Danish kroner has been much more stable than that target zone. And in fact, the currency target zone means that the Danish interest rates and central bank rates have been decreased recently because there's such a great inflow of money from European investors because of the higher Danish money market rates. And actually it means that there's a reverse currency regime where the fundamentals and the flows are supporting Danish interest rates and returns on Danish bonds.
If we look around Europe, then the Greek government, their defaulting on the debt is causing much concern in the financial markets. How does that affect the investment in Danish bonds and the interest rates?
A lot of things could be said about Greece, and I won't do that here, but Denmark is not Greece. What is causing concern is the possibility of a domino effect. If Greece should default on its debt, which country will be next? And one highly valid question is, would Denmark be in the same position? And if you look at debt ratios and budget deficits and the funding of government debt and private debt in Denmark, it is clear that Denmark is in a much different situation than Greece. Actually, if you look at those debt ratios, you will see that only very few countries are in the same position that Denmark is at the moment. We're talking about countries like Norway and Australia, which are countries that almost do not have any need of any government debt. So I believe the fundamentals really support Denmark, also compared to other core countries in Europe like France or Germany.
Your fixed income funds, they invest heavily in mortgage bonds. How do you see the risk in connection with mortgage bonds?
Mortgage bonds are bonds that have cover in underlying residential and commercial real estate. And of course the crisis in the property market has to some extent affected this market in Europe. But the Danish market has had a history of more than 200 years with no defaults. and it also means that there's a quite sophisticated regulation in place. The private debt ratio and the mortgage debt ratios in Denmark are quite high, but one should also consider that there's a sophisticated pension system that acts as a huge investor in these markets. So there's a natural demand for these bonds. But our investments will of course reflect the view that we have on the different mortgage issuers, and we are constantly monitoring the loan-to-value ratios and the financial figures for the different mortgage issuers. And we also have a rebalancing between government bonds and public agencies and mortgage issuers that we are utilizing in order to get the best possible return for our investors.
How has the long Danish bond fund performed through the financial crisis and recovery?
Of course, we got a dip in 2008 and the beginning of 2009 because that was what happened to covered bond markets all over Europe. But the Danish market has benefited from a high degree of liquidity and market-making agreements in the financial banking sector that actually worked during most of the crisis. And it also means that during 2009, much of what was lost simply by bonds being thrown out and losses being realized, much of that has been gained again during 2009. But there's still a high potential in Danish mortgage bonds compared to, say, other highly secure bond investments in Europe.
If we look at the first quarter of 2010, how has the bond market or your fund performed so far?
Looking at the different European government bond markets, Danish government bonds has been among the best performers in 2010, and mortgage bonds have had a similar return as Danish government bonds. So it means that the return for the first quarter of 10 has been around 3%, which is quite high compared to other European countries, not even mentioning Greece.
And if we look at the second quarter 2010 and the rest of the year, what are you expecting from the bonds?
It's very difficult to predict what will happen in Greece, but one should probably not think Europe break up, but evolution on the political side, which is something which, being trained as an economist, is very difficult to predict. But I believe that the situation or evolution in Greece will only have a limited impact on what will happen to the Danish bond market. So what we're looking at our projections for the rest of the year is a positive return for the rest of the year. And we believe that due to the situation that Denmark is in, we will have a superior return compared to other European countries on the long Danish bond fund.